Welcome investors, and thanks for joining us on your Investment Advisor channel, where we decipher the markets so you can make actionable investment steps. I'm Jake Ackerman. A blowout jobs number in the private sector gives the Fed the cover they need to raise interest rates at least 2 more times at a minimum. The Fed minutes show us that the Fed economists expect a mild recession later this year. That is their forecast. Also, their previous forecast was a mild recession early 2023. Also, the Fed forecast was a mild recession end of 2022. So let's just get right into it and take a look and try to decipher what exactly is going on. So I want to start with last month's Fed meeting. We get the Fed meeting minutes giving us the insights into the minds of the Fed officials and the economists at the Federal Reserve. And with the release of the Fed minutes, let's see what they said. All right, the bottom line is that interest rate policy hasn't been restricted enough for long enough. That's not saying that they're going to raise interest rates because they paused during June's meeting, but that is saying that they're going to keep rates high for a long period of time. Next, the Fed staff economists have continued to forecast a mild recession for later this year, though they also said the probability that the economy will continue to grow slowly was almost as likely as a downturn. They're just telling us they have no idea when this mild recession is going to take place. It's predicated on, we need to see the jobs numbers, we need to see GDP give us at least 2 quarters of negative growth. We've seen that last year, except the jobs numbers remain strong. So that didn't necessarily translate to well, I guess they changed the definition, right? It used to be 2 quarters of negative GDP was a recession, but now we have this dynamic where it just really didn't add up. And that's the truth. Jobs were strong, people were still working, people were going back to work from their pandemic phase, the COVID-19. So it wasn't this mass layoffs, people losing their houses. So it really did not add up to a recession. Now, when is a mild recession? Is that likely towards the end of this year? At this point, with this blowout jobs numbers, I think that the Fed meetings minutes for the July meeting here at the end of this month, which we'll get in August, might sing a different tune. Maybe they move back that timeline on the recession again, because the jobs are strong right now. Is that necessarily the case right this very second? Jobs data is difficult to calculate. It's delayed. You have smaller businesses who are doing different things than the larger businesses. I mean, you heard reports like Apple, Amazon, Google, these big high tech companies were laying off employees. Silicon Valley companies were laying off employees months and months ago. But we're still seeing these small and medium-sized businesses, the moms and pop shops, still bringing on customers because their local economies are still strong in some areas. Not everything across the U.S. is in the same situation. I have clients over on the West Coast, and I have a lot of real estate investor clients that tell me on the West Coast that their market is struggling out there. It's a completely different market. And then I'm in the Clearwater, Tampa Bay area. Our office, a lot of our clients over in this area, and things are holding up strong. So on the East Coast, it's a completely different scenario. So the U.S. economy is all on this different timeline right now. And what's going to come to fruition is only going to be, we're only going to know in the future here, obviously, and we can only forecast so much. But there's clues starting to add up. There's things starting to add up, right? And it's because of the Fed's restrictive monetary policy. Now, I told you at the beginning we had a blowout private sector jobs numbers, and let's take a quick look at that so we can discuss and figure out what's going to take place and when this potential recession could happen, whether that's mild or is that a deep recession. Take a look at your screen right here. So we have the private sector, which is the ADP Employment Report. And the expectation was 220,000 new jobs. Well, we got more than double that, 497,000 new private sector jobs. So that's significantly higher, right? Higher employment can lead to inflation in the future. So that means the Fed was going to want to squash that inflation because inflation destroys savings. It destroys your purchasing power of the dollar. And you know what also destroys things? Fed raising interest rates. And this is the cover that they needed, right? And at the same time, we had another report this morning, and it's a little bit mixed, but it's a little bit different. I'm going to show you, let's take a quick look at this, all right? And again, this was Friday morning at 8:30, non-farm payroll, and that's instead of just private sector like ADP, this has private and public sector, so government jobs. Expectation 225,000, well, we got 209,000. Unemployment report ticked down from last month at 3.7 to 3.6. Expectation was 3.6, so surprisingly, unemployment came down. And for them tightening interest rates, you wouldn't necessarily expect that. But we got to understand in our minds that them tightening interest rates is not an immediate reaction. And if you look in history, it can take 1 to 2, maybe 3 years to feel the full ramifications of their tight monetary policy. So, you know, we have inflation data coming down, and they're trying to toe this balance of not trying to raise unemployment. And unemployment can tick up very fast. When I highlighted the big businesses laying off, man, they were laying people off left and right, like month over month, consistently. And they've started to slow down. But the small and medium businesses haven't felt that yet. And here's a thing to think about as well. The large mega cap businesses have understanding operations all through the US, all through the world. So they have, I guess you could say, their tentacles all over. They have a better grasp of what's really going on, where your medium-sized businesses and small businesses are only localized. You know, they're not understanding what's going on the West Coast, the East Coast, the Northeast Coast. They're not understanding what's going on in Europe because they're not focused on Europe. So they're going to be the last ones to know when we actually do get hit with a recession, even though they're going to get affected the worst because the big businesses have flush with cash. They can lay off more employees, they tighten up their balance sheet because they can shed lots of employees. They have lots of employees, and they have generally a leeway in their profit margins. So that's something to understand, these cycles. You know, the big businesses lay off first, and then where do those big businesses employees go? They're going to go to the small and medium businesses. They're going to hire, and then when the small medium businesses start to feel the ramifications, they're going to start letting those new people they just hired go, perhaps some workers that were looking to retire, or, you know, they're going to make their own decisions internally. So again, let's go back to what the jobs number yesterday told us and how I know that they're going to raise interest rates. And it's my favorite market to watch. I highlight it all the time. That's the bond and interest rate market. So I want to show you guys the 30-year interest rate, again, which is tied to the bond market. So let's take a quick look at what the numbers are telling us. So right up I have in front of you here is the 30-year mortgage interest rate, again tied to the bond market. Bond prices go down, interest rates go up, vice versa. It's like a seesaw. This is 1 month time frame. And you can see last week, preemptively, the interest rates started increasing. They started shooting up preemptively before the jobs number even took place. Markets are very efficient at forward looking. They're going to tell us what the Fed's going to do before they haven't even hiked interest rates yet. And interest rates are already going up. They're telling us that they're going to hike interest rates. And they said at least 2 times at a minimum, I think. We get more hot jobs numbers before we see this cooling effect. We can easily get more than 2 interest rate hikes, even though inflation data is coming down. So there's going to be this, they're between stuck in a rock and a hard place. It's going to be very difficult for them to navigate it, of over-tightening, which is a real possibility they over-tighten. Now, they still have quite a bit of leeway to see with the jobs numbers, and there's going to be this delayed effect where, again, medium and small businesses are going to look to lay off some of their employees. So let's, I'm going to touch on, last thing is interest rates and bonds. Interest rates are going up, bond market's going down. That's the institutions, the best investors in the world are in that hemisphere, in that sector. So that one we really need to closely monitor. And it's doing something different than the equity markets. stocks have been going gangbusters, have been going through the roof. The stocks are preemptively thinking the Fed are going to stop raising interest rates. And so we have a divergence. Bond market's saying the markets should go down. Stocks are saying, nope, we don't believe you. We don't believe the Fed's going to hike interest rates. Everything's going to be fine. And I have a feeling that's an experience called fear of missing out. And equity traders are known to have what's called FOMO, fear of missing out. So we have that going against the equity markets. And seasonally, the summer months are generally a more consolidation period, meaning sideways, perhaps down. So, keep that in mind as investors. Stick to your long-term investment plan. We'll touch base next week. We have a really important data point on Wednesday, CPI, Consumer Price Index, which is an inflation report. And we get a hot one, it's all but certain that we're getting that interest rate hike, probably more. Then means inflation's ticking back up. That throws a wrench into a lot of game plan right now for a lot of traders that are trading the bond market and interest rate market, even though they're going to hike interest rates, because if inflation starts creeping up, that means our timeline's a little bit different. But look for interest rates, or not interest rates, but look for inflation data to keep coming down, jobs markets to be a little bit hot maybe for the next month or two, as this rotation between large businesses, medium-sized businesses, and small businesses takes place over time. This is a gradual process, folks. And, we still have not felt the full effects of the tight monetary policy. So if you got some value from this video, do us a favor, like and subscribe below, and stay with us. Expertise you deserve, experience you can count on.